So today is Thursday, and that means time for a official Federal Reserve balance sheet update. Now, normally with the Federal Reserve balance sheet and the fact that we have not QE officially announced starting, I think Powell announced it, Jerome Powell announced it October 8th. We have Repo Madness, which has been going on officially since September 17th. The balance sheet, the Fed's balance sheet has been going up consistently. The official balance sheet has been going up consistently. And it has not gone down from what I've looked at it in the last couple hours just researching this. The Fed's balance sheet has gone sideways a little bit over the last 3 months, but I believe this is the first time in 3 months since the end of August that the Fed's balance sheet, and I was shocked to see this, this was a bit of a surprise, that the Fed's official balance sheet in the last week has actually gone down. Now, it only went down $17 billion. It's, in the whole scheme of things now, $17 billion is not really that much anymore, because now with the Repo Madness, I've talked about this, that the Repo Madness at some point it's going to end up being, I don't know if they're going to officially announce this or not, but the Repo Madness is going to end up being averaging $300 billion per day. So welcome to dystopia. The New York Fed already announced in a November 4th speech, a vice president at the New York Fed announced that Repo Madness was averaging $190 billion per day. So when you add up the overnight repos and then you add in the 14-day term repos, and soon you have the 28-day and 42-day term repos kicking in. They have not kicked in yet. We've also had now over a full month of not QE, and that's only $60 billion per month. Soon it will be more than that. I put a chart there on your screen. So even though the Fed's official balance sheet over the last week is down $17 billion, that is the amount of U.S. Treasuries that the Fed has purchased. So the amount of U.S. Treasuries bottomed towards the end of July and early August. The amount of U.S. Treasuries got to almost right around $2 trillion. And since then, as you can see on the chart there on your screen, it's gone up a lot. It's gone up, over $120 billion. I think the exact number, I did the math for you, the exact number is $139.661 billion. It's gone up in 4 months, about 4 months. So not QE is only supposed to be $60 billion per month. Not QE has only been going on for a little over a month now. I think the not QE purchases kicked in mid-October, October 15th or 16th approximately. So not QE is only $60 billion per month, and yet here we have evidence that the Fed, with their official numbers, has been buying a massive amount of U.S. Treasuries. And this makes sense because the foreign governments are now net sellers of U.S. Treasuries, and that amount has actually kept, the amount of selling by foreign governments has actually kept increasing. But the amount of purchases of treasuries by pension funds, other U.S. entities, primary dealers here in the U.S., which are the large banks, that has gone up a lot. Wolf Richter actually ran an article on this. Let me pull it up. I think earlier this week. Is it loading? I always hate it when you have too many windows open during a live stream show and then the windows crash. Okay, this article from Wolf Richter is from November 18th. U.S. national debt spiked by $1.3 trillion in 12 months, up to $23 trillion. But who bought this pile of Treasury securities? So he talks about the massive net selling of foreign governments, how it's continuing, and the amount of buying by U.S. entities. U.S. government entities bought $170 billion in Treasury securities over 12 months, bringing their total to $5.9 trillion by the end of September. Treasury securities debt held internally or held by Social Security Trust Fund. Government pension funds belong to the beneficiaries of those funds. Month of September, holdings of Treasuries increased by $22 billion. Let's see here. The Fed shed $25 billion in treasury securities over the past 12 months, but it is okay. So if you look at that chart, I believe net, it's still below what it was at the end of 2018. So it's not back to those levels. So quantitative tightening kicked in Quantitative tightening sold treasuries. Quantitative tightening sold mortgage-backed securities. A lot of the mortgage-backed securities that rolled off were reinvested into treasuries, supposedly. John says 140 billion here, 140 billion there. Soon you'll be talking about real money. Yeah, it's amazing how with the first couple quantitative easing programs, it was, oh, we're going to do a couple hundred billion, or oh, it's going to be 500 billion, and everyone was shocked. And now the problems are with Repo Madness, we're getting to almost those levels, about half of that per day now. It's getting there. If you add in the repo that China's doing with the repo that the US is doing, it's in the mid 200 billions per day already. And I think my thesis is that, yes, President Trump invited Jerome Powell to the White House with that meeting that was talked about. Trump wants more quantitative easing, the amount to increase. And yes, Trump has talked about negative interest rate policy on Twitter, because he thinks that's beneficial, even though I disagree with him. I could not disagree with him more about negative interest rate policy. It is not benefiting the European Union, really anyone in the European Union, except for over-indebted governments. Those are really the only beneficiaries in the European Union of negative interest rate policy. All the other entities, whether it's insurance companies, large banks, savers, pension funds, everyone else is getting killed through negative interest rate policy in the European Union. But I believe, my thesis is that Trump wanted an update on the repo market. That was one of the main, that they will not talk about in public, that Trump wanted an update directly from Jerome Powell about the repo market because it is getting so big and so absolutely ridiculous at this point. So let me play a clip from my buddy James Anderson, who works for Silver Doctors. He pulled the Jerome Powell testimony, congressional testimony from last week. So I'll play a clip of this audio right now, and you can listen to Jerome Powell. And there was a brave congressman from Texas. I forget the guy's name. I think James talks about it in this audio clip before he plays the Jerome Powell being asked about the repo market. And Jerome Powell's response about the repo market is ridiculous. I'll let you hear it, and then I'll talk about it afterwards.
The Federal Reserve's chairman, many-time multimillionaire Jerome Powell, testified before U.S. Congress this week. Only one congressman, Kenny Marchant, Republican from Texas, had the nerve to ask Mr. Powell about the Federal Reserve's intervention in the repo loan market bailouts beginning this past September 17, 2019. Have a listen to this most important section of their back-and-forth Q&A.
And next question, the disruption in the repo market that took place in September. Anticipated, not anticipated? Do you anticipate keeping the expansion at the level it is until you're sure that won't happen again?
Well, so anticipated or not, it's a different world post-crisis, and really because of all the expansion in our balance sheet and essentially what we've done now is we've now required financial institutions to have a lot more liquidity on their balance sheet so that the Fed doesn't have to run in and with our own liquidity. So that's I think a big benefit to the financial system. But a lot of that liquidity is held in our reserves. We used to manage the interest rate by keeping reserves scarce, and we had a total of 20 billion. Right now we have in excess of 1.5 trillion in reserves, and so that means that we're trying to find that level as we allowed the balance sheet to shrink, where reserves would become scarce, and there was really no way to know. I think the data that we had suggested that we were not close to that point until September. I think we're still very much looking at what happened in September, but I think we learned in September that we needed to make sure that reserves didn't go under that level that we were at in mid-September, which is a little bit shy of 1.5 trillion. So that's really what we're doing. It's technical. I think we have it under control. We're prepared to continue to learn and adjust as we do this, but it's a process. I would say it's one that doesn't really have any implications for the economy or for the general public, though.
Thank you.
Oh my God. So he was lying through his teeth. Let me just summarize using Kevin Bacon's character from Animal House, my impression of, well, it's going to be Kevin Bacon's impression of what Jerome Powell was doing there. And Jerome Powell, bad lying, bad acting. Here we go.
Remain calm. All is well. All is well.
Okay, one of my favorite clips from from any movie. That scene with Kevin Bacon was just amazing. He gets trampled. They couldn't make that Animal House movie again because of the politically correct culture. So he was lying through his teeth. He said in that congressional testimony there that the Fed is not providing liquidity. Then what the heck is Repo Madness? Then why is the Fed lending on quote-unquote good collateral? Then why we are at insane amounts of overnight lending? Then why is there 14-day term repos that were added? Then why was the amount of the term repos, 14-day term repos, why has it been increased? Then why has the size of the overnight repos been increased? Then why is there going to be 28-day term repos? Then why is there going to be 42-day term repos? Then why will they increase the size probably eventually after that? Then why will they then transition all of this garbage and roll it over permanently into a permanent repo facility? Oh, but it's not QE. That rant was totally off the cuff, by the way. That's just angry and frustrated, just ridiculous. He was lying to Congress. Hopefully there is a halfway decent congressman, Republican or Democrat, that will listen to this podcast and find the information. And the information's even buried in the Fed's own words, where they were talking in the Fed minutes that repo is a big issue. They were talking about this before it came public months. June and July, it was being talked about in the Fed minutes. They were getting worried. So welcome to dystopia. There was it's behind a paywall. It's a Financial Times article by Karen Petrou, Petrou. She put out an article recently called Repo Ructions Highlight Failure of Post-Crisis Policymaking. I got the first paragraph or two, and the rest of it's behind the paywall. I'll just read the first couple of paragraphs. The rest of the article, if you want, it's going to be behind the Financial Times paywall. So the old Greenspan put is now a Powell promise. Fear not, the Fed is there for you. A big failure of post-crisis financial policy was laid bare when the U.S. repo market buckled in September. Many have debated why the market went wrong so fast. The Federal Reserve was so spooked that it did not wait for answers before stepping in. The central bank's gross cumulative support for the market, which allows banks and investors to borrow cash in exchange for treasuries and other quote-unquote high-quality collateral, will top, and here's a crazy number, yes, all of it's not being added to the Fed's balance sheet yet, but we don't know for sure because there is no independent audit of the central banks, especially the Fed. So the cumulative support for repo is supposed to, according to the projections from this article writer from the Financial Times, will top $11.5 trillion by the end of January 2020, according to research from the people at Financial Times. The Fed did not just stabilize the repo market. Now the Fed is the repo market. Repos were once the liquidity providing plumbing, in air quotes, of the financial system. Now they have taken on another role because post-crisis rules demand that financial institutions hold far bigger balances of safe assets at a time when yields on such assets are low or even negative. Also, I would add, and she didn't mention this, at least in the first couple of paragraphs, the banks don't trust each other because they could earn extra money lending to each other. Yeah, the Fed's balance sheet is still up. If you subtract the 17 billion, so it was like 288 billion last week, so minus 17. So it's still up over $260 billion in only about 3 months. I think this reduction in the official balance sheet, it is a head scratcher. It is a surprise. I do not expect it to be a trend, given how much repo is out there, how much not QE is kicking in. It doesn't make sense for there to be a lot of official decreases a lot of decreases in the Fed's official balance sheet. This was surprising, though. I expected to see another increase of, 10, 20 billion, something along those lines. The Fed is still selling a lot of mortgage-backed securities. The Fed had, a year ago, $661,830 trillion worth of mortgage-backed securities. Now it is down to 1.437197 officially. So almost. I didn't use a calculator here. I'm not going to do the math off the top of my head, but 461. So it's they've sold off more than $200 billion. About 200, almost 220 billion approximately. The Fed has sold off of mortgage-backed securities. No, I don't care about the Cybertruck presentation. Thank you for the super chat, Jarek. I appreciate it. So the Wolf Richter article that came out on the 18th, November 18th, it goes through more in depth of who's buying the treasuries. Let me get the primary dealer numbers out here. Okay, American banks, institutions, other individuals bought the remaining $503 billion of treasuries over the past 12 months, bringing their total holdings to $7.74 trillion, or 34.1% of total U.S. debt. This includes the primary dealers, the broker-dealers with which the Treasury Department does business. The amount of treasuries primary dealers own has ballooned. Their holdings are now, over the last 12 months, have increased by 70%, or $79 billion to $190 billion, according to Wolf Richter. And earlier, I think in February of this year, much earlier this year, that the amount, I think, of treasuries was at a record high this year. It was almost at a historic level, I think, in February. Oh no, I had a bunch of articles open. I can't find the one I'm looking for right now. Oh, here we go. Primary dealer treasury holdings hit all-time highs. Foreign buyers were dumping. This was from February 8th, 2019. And the gold community is spinning things that they're dumping treasuries to crash the dollar. It's more complicated than that. Let me read you some tweets from my friend Emma Molman. I reached out to her for an interview. She's too busy right now, but she put some tweets together explaining why these foreign governments, foreign banks, foreign corporations, they need US dollars more than they need treasuries. And it's because, like I said yesterday, of the total amount of dollar-denominated debt in the economy, and it's becoming onerous when you have the dollar index almost at 98 again. It's at 97.96. So the dollar is staying relatively strong relative to the other global fiat currencies. So I'll read you her tweets that she put out. Let's see here. Okay, so she says, and this is why there's more demand for dollars now and not U.S. Treasuries. She said, when rates were 0% from the Fed and dollars easy to come by, emerging markets and others went nuts, taking out loads of dollar debt to fund mining, shipping, other projects to supply China's inflated demand. Reckless and unsustainable stimulus created a muse of artificial demand that couldn't last. So Austrian school economists would call this misallocation of capital. The emerging markets did it. China did it. They were gambling on a weak dollar, on the Federal Reserve routinely expanding their balance sheet, not doing quantitative tightening, the Fed not raising interest rates, and the dollar continuing to go down. Remember, the dollar in 2011 hit all-time lows. That was not the time to be borrowing as much dollars because the dollar has rallied in the last couple years. Then global demand began slow. This is our second tweet. Then global demand began slowing from east to west, emanating from Southeast Asia to Europe and elsewhere. Just as dollar supply from the Fed evaporated fast, and Powell pretty quickly, and Powell reduced global dollars available for euro dollar markets substantially in under 2 years. Naturally, then overcapacity became a problem. See, people talk about, like people in the Austrian school, like Peter Schiff, who I don't think analyzes China very well. He talks about, well, China produces goods, but you can still have overcapacity. You can still waste capital with manufacturing and building factories and produce goods that there's no demand for, or demand is falling, or issue a lot of debt to factory owners that they can't pay back. So you can have overcapacity, you can have misallocation of capital with factories. A lot of people in the Mises Institute and Austrian School of Economics don't recognize this. So in her opinion, overcapacity became a problem. Emerging market revenues fell while interest and principal payments come due at the now more expensive US dollar foreign exchange rate relative to the other currencies. So these foreign governments have no room to expand their foreign exchange reserves with new treasury purchases. They're still struggling to make interest payments on the dollar-denominated debt they have. Good analysis from Emma. I am still working to get her back on a podcast. Her schedule is just really bad for the next, looks like 6 weeks or so. So I did reach out to her, try to get her back on. Kyle says he feels like we are being conditioned by the Fed to get used to the repo stuff. The numbers are so crazy now, it's hard to even imagine 100 billion. Yeah, well, it's over 100 billion per day. And I don't know if they're conditioning us, Kyle. I would say that they're telling us it won't affect the real economy. I just go back and listen to that Jerome Powell clip if you didn't hear it. Go back after the show. And Jerome Powell was saying that it doesn't affect the real economy. And I would tell you that it does. It definitely does affect the real economy, because the average person then, they're trying to inflate asset prices. These governments are so worried about capital gains taxes on stocks, bonds, and real estate falling that they won't balance their government budgets anymore, and that the government would, these big bloated big governments would have to cut spending. That they want to manipulate asset prices higher. I'll do another video on this, but let's just say a number of different governments all over the globe are talking about banning short selling again. There was a story that came out in Reuters this week that a number of governments all over the world are talking about banning short selling because they don't want asset prices falling. This would go back to rule number one. Rule number one is they're going to change the rules. So I don't see any more super chats. The bottom line then, to wrap up this short little podcast, is that it was shocking to see that the Fed's official balance sheet did decline, considering the amount of repo that's still out there and how the 28-day and 42-day term repos are going to kick in the near future. And the Fed still has to buy a lot of treasuries. So the U.S. Treasury was supposed to need, I think, over 800 billion. It was like 800. I did the math, and their estimates from the U.S. Treasury over the summer were that for the rest of the year, the U.S. Treasury was going to need to sell a minimum of $814 billion worth of treasuries by the end of 2019. So I haven't seen the exact number that they've sold so far, but I don't think it's anywhere near the $814 billion yet. So the Fed's going to have to keep buying more treasuries. There is demand for treasuries with, U.S. pension funds and other U.S. entities, but foreigners are not running trade surpluses. Foreigners have dollar-denominated debt problems, so foreigners cannot accumulate surpluses because they have enormous debts to pay back. So foreign governments cannot accumulate lots of treasuries. They have to liquidate because they need dollars. If you sell treasuries and you're a foreign government, you go to dollars. And they need those dollars. They need to pay back dollar-denominated debt. This is what a lot of people in the gold community and alternative media don't understand. It's a lot more complicated than petro yuan, China collapsed dollar. China's going to a gold-backed cryptocurrency. China's going to a gold-backed yuan. China's going to gold-traded notes. China wants a lot more dollars. I've heard a number of stories lately, anecdotally. In fact, a lot of the loans, the RMB loans, from what I've heard from sources now, that the RMB loans that the Chinese government gives out to these third world countries, that China hedges their currency risk, knowing that they're printing the yuan and RMB very, very rapidly. And China asks some of these countries in Africa and South America that they give loans to pay them back in dollars. So the Chinese government is asking for some of the loans they give back, not all of them, for some of the loans they give to these third world governments to be paid back in dollars. You won't hear that from any expert in the gold community. You won't hear that from any expert in the alternative media. China wants dollars. China needs dollars. So as much as these governments would love to get to the next system, if they don't pay their dollar-denominated debt, they could collapse immediately. And none of these governments want to collapse immediately. None of them want to default immediately. No one wants to be the first big government to default. Okay, so I've given you some more stuff to think about, but that is a very interesting chart there with the amount of treasuries that the Federal Reserve has officially bought. It bottomed out before quantitative tightening officially ended. So before quantitative tightening officially ended, the Fed was already buying more treasuries. I believe quantitative tightening ended, the end of August? So the Fed was already buying more treasuries before they officially announced the end of the quantitative tightening program. And the Fed was already expanding the balance sheet before quantitative tightening ended. The Fed's balance sheet is still up over $260 billion since the end of August. I think the $17 billion over the last week drop is a bump in the road in the Fed's continued increase in their balance sheet. And most financial professionals are totally okay with this. You won't hear criticism like this or almost anything I just discussed, especially the repo market. You won't hear any of that really on the mainstream financial media because it's, stocks, should we buy this dip in stocks? Or is there going to be a trade deal? Is that going to be good for stocks? Okay, well, that's it for now. I want to thank everyone for listening, and I want to continue to focus on creating unique content. I may have an interview guest tomorrow, hedge fund manager. We'll see. Looks like there's going to be one. I won't name the name until the interview's done. You'll just have to wait and tune in tomorrow and check. And thank you very much to my almost 200 Patreon account contributors. Hopefully I will have over 200 in the next couple weeks or so. Hopefully by the end of this year. Thank you very much to my dozen monthly PayPal contributors. And people throw me a tip once in a while. It's much appreciated.